This is an analysis from Alpha Business Media. Welcome to the deep dive. Today, we're looking at a market that, on the surface, seems like an incredible success story. I'm talking about the Fintech sector in Nepal.
That's right.
We're diving into what we see as a really crucial paradox. You've got this market with explosive growth in transactions, but at the same time, it's facing this existential crisis.
Right. Analysts are predicting a brutal consolidation is on the way.
A brutal one.
And that's the core of it. If you just look at the raw numbers, the metrics, you see QR payment volumes up over 1,000% since the pandemic. It looks like a huge win for financial inclusion.
It does.
But just beneath that surface, that success is actually hiding some really deep structural problems. And it's all fueled by, well, just aggressive market saturation.
And you can actually see the symptom of this problem on the ground. If you, our listener, were to walk into a little neighborhood shop, a Kirana store in Kathmandu today, you wouldn't just see one simple way to pay.
No, not at all.
You'd see a whole collage of them. You've got Sewa, Kalti, maybe a bank's QR code, phone pay signage everywhere. It's just this visual cacophony of competing systems.
And that visual noise, it's the physical proof of too many players fighting over the same tiny low-margin transactions. The irony is that all this choice has created enormous complexity, not the frictionless world we were promised.
So our deep dive today has a pretty clear thesis.
It does. The next 24, maybe 36 months in Nepali fintech, it's not about growth anymore. It's about survival. It's the fintech Hunger Games.
Okay, so let's unpack that. How did we get here? How does a country go from being so heavily cash-based to having, over 24 licensed payment service providers?
Yeah.
The speed is just... it's astonishing.
It really is. It was a perfect storm of three major forces.
Okay.
First, there was this very obvious low-hanging fruit, a clear market gap. The early companies, like Isia, they focused on solving real pain points for people.
Like paying your utility bills.
Exactly. Standing in line for hours just to pay your electric bill, or buying scratch cards to top up your phone. They digitized these really annoying but frequent processes, and that gave them instant revenue and, proof that the model worked.
So they didn't have to create a new behavior from scratch. They just made an existing painful one much easier.
Precisely. That guarantees you'll get some initial adoption.
Hmm.
Then came the second force, and this is maybe the most important one, deliberate government policy.
The Nepal Rashtra Bank, the NRB.
Right. The NRB kept the initial capital requirements for these companies incredibly low. They wanted to encourage as many players as possible to jump in, to break that inertia of cash.
And it worked.
It worked, maybe a little too well. It lowered the barrier to entry so much that it basically signaled a gold rush for local entrepreneurs and VCs.
Which brings you to the third force, which I imagine is the copycat effect.
Absolutely. You had these massive success stories globally. India's Paytm, China's WeChat Pay. To an investor, the wallet model looked de-risked. It felt like a much safer bet to launch another wallet than to, say, innovate in a truly new sector like agritech.
And then the whole thing was put on steroids by standardized QR network.
Yes, specifically PhonePe. I mean, think about it. Normally, a new company would have to spend years and a fortune building a merchant network.
Right, going shop to shop.
But with PhonePe, a brand new wallet could just plug in. Instantly, they had access to the same thousands of merchants as the big established players.
So the core function, just accepting a payment, became a commodity overnight.
Instantly commoditized. And that's where the structure gets so brittle. Because if everyone has the same acceptance network, the only way to compete is to just burn cash on incentives. Cash back, discounts.
So you end up with 24 startups that are all basically the same, fighting over the same users with the same low-margin service. Saturation wasn't just a side effect, it became the main feature of the market.
And this leads us straight into the core problem, what we're calling the fragmentation paradox.
Okay.
Nepal has achieved breadth. A lot of people using digital payments, which is great, but that very saturation, all those players, is what's preventing the market from achieving any depth in financial services.
That makes a lot of sense. We've digitized the payment, but we haven't actually unlocked the user's financial life. So what does that friction look like for, say, a normal user?
For the user, it's a mess of walled gardens. Let's say you have 1,000 rupees, but it's split across 3 different wallets.
Okay.
But the coffee shop you're at only takes Kalti, and most of your money's in Isewa. That money is essentially stranded. You either have to do a clunky bank transfer to move it, or you just give up and use cash.
So Fintech, which was supposed to remove friction, has actually just created a new digital kind of complexity.
It has. And for the merchant, that small shop owner. It's even worse. They're not a big corporation with an accounting department. They're managing relationships with multiple providers, trying to track different settlement timelines, navigating different fee structures. That administrative headache can easily wipe out their tiny profit margin.
But why aren't the merchants just demanding a single unified system then?
Well, they sort of are, just by still accepting cash. The complexity is a barrier. But the really deep problem here is data poverty.
Ah.
The real prize in financial inclusion isn't the 10 rupee QR payment. It's being able to offer microcredit, insurance, lending services for the underbanked.
The holy grail, as you put it, using the data to actually understand your customer's risk profile.
Exactly. And to do that, to build a reliable credit score, you need rich, long-term data. Spending habits, payment history, signs of stability.
But if my digital life is split across 5 different apps?
Then no single company has that holistic view. No one has the data to build a good credit model.
So the walls are stuck. They're trapped in this low-margin transactional phase forever because the market structure itself prevents them from getting the data they need to graduate to the profitable lending phase.
That is the structural failure in a nutshell. And it's such a stark contrast to India's UPI model.
Right, which is a public utility.
It's a public utility. UPI commoditized the payment layer for everyone, which forced companies like Paytm and PhonePe to innovate on top of it. They had to compete on value-added services, not on the payment itself. Nepal's model of competing private rails ensures the competition stays stuck at that low-value layer.
Which brings us to the big strategic blind spot. The super app playbook always says payments are a feature, not the product. So what did so many of these Nepali companies miss?
They missed the importance of an anchor, a reason for the user to be locked into your ecosystem every single day. Look at the originals. Alipay wasn't just a payment app. It was born out of Alibaba's Taobao, a massive e-commerce site.
You needed it to shop.
You needed it. It was essential. Same with WeChat Pay. It was layered on top of WeChat, the messaging app that 1 billion people were already using for hours every day.
So the anchor, whether it's shopping or chatting, guarantees that high-frequency use. It makes cross-selling financial products almost trivial. The payment is just a feature on an already crowded highway.
Exactly. But in Nepal, most of these companies were payment first. Their main use case is something you do maybe once a month, like pay a bill. That creates almost zero stickiness.
I love that analogy from the source material. They built the payment gateway without first building the city it was meant to serve.
It's perfect, isn't it? If your service isn't essential to a daily non-financial habit, you're just constantly burning money on incentives to keep users from switching. And that is a losing game.
But we are starting to see some panic moves to fix this, right? To find an anchor after the fact.
Oh, absolutely. The big players are scrambling. The clearest sign is the eSiwa Group acquiring the e-commerce platform Sasta Deal. That is a direct attempt to bolt on an anchor.
To retroactively build the city.
Yes. But the real dark horses to watch here are the ride-hailing apps. Companies like Pathio or InDriver.
That's interesting because that's a high-frequency daily use case.
It is. You might use a ride-hailing app multiple times a week or even a day. That provides predictable demand for payments and, more importantly, a treasure trove of data about movement and spending habits. If one of them successfully pivots into financial services,
They could be a huge threat to the incumbents.
a massive threat. So the takeaway for the existing wallets is pretty brutal. Find a strong anchor and find it now. Or you risk just becoming a feature inside someone else's super app.
So this freewheeling growth era, it's clearly over. We're now entering what you called a phase of strategic ruthlessness. The prediction is we go from 25-plus players down to maybe 2 or 3. What are the triggers that are going to make that happen so fast?
The first trigger is just pure investor fatigue. The VCs who funded this gold rush are done. They're not interested in funding another wallet that's just burning cash on tiny transactions. The math doesn't work.
So the money's not for new players anymore.
No. The capital's going to shift from funding startups to financing roll-ups. That is strategic M&A to create scale and force a path to profitability. The investors will become financiers of consolidation, not growth.
And the second trigger.
A big regulatory push for stability. The NRB lit the fire, but now it has to make sure the whole forest doesn't burn down. So they're going to raise the bar. We expect they'll increase the paid-up capital requirements, and they'll demand much stricter compliance on things like anti-money laundering and data security.
And all of that, the security software, the compliance teams, that's expensive. It's a fixed cost that a small cash-burning player just can't afford.
Exactly. It creates a regulatory moat. It forces the smaller players to either sell for pennies on the dollar or just shut down.
Hmm.
The regulator becomes an engine of consolidation, whether they intend to or not.
And the third trigger is the big players themselves going on the attack, the M&A blitz.
Right. And this won't just be about buying user lists. This will be strategic acqui-hiring or acqui-featuring, meaning a big player might buy a smaller one just because they build a really good bus ticketing platform or because they have a strong, loyal user base in a province where the bigger company is weak. They're buying puzzle pieces to complete their super app vision faster.
So if you're a founder of one of these smaller PSPs today, the goal isn't to win, it's to get acquired.
That's the hard truth.
Okay.
The winners in 2 to 3 years will likely be a combination of a big bank-backed player, a legacy fintech that managed to buy an anchor, and maybe that ride-hailing dark horse.
Hmm.
For almost everyone else, the job now is to make your company an attractive acquisition target.
This whole story is such a crucial lesson for anyone watching a market. Those early success metrics, the massive transaction volumes, they actually blinded everyone to the long-term structural weakness.
Oh,
The data poverty, the lack of an anchor.
exactly.
The game has completely changed. It's no longer about getting into the market. It's about dominating it or getting out. The era of the fragmented, low-margin digital wallet is officially over.
And if we look just beyond this consolidation, think about the power shift that's coming. If 2 or 3 super apps really do achieve that data scale, they will know more about consumer creditworthiness than anyone else. What does that do to Nepal's traditional, slow-moving banks, especially when it comes to consumer lending?
That's a huge question.
And what new regulatory challenges come up when just 2 private companies control the digital operating system for millions of people? We're talking about anti-monopolies, data governance. These are problems the regulator is only just beginning to think about.
And that shift in the power of credit. That's where the next story really begins. Thank you for joining us for this deep dive into the coming consolidation of Nepal's fintech market.